Have you ever wondered what the option sweep is and how it works? If so, you're in luck. In this blog post, I'll provide a brief overview of the option sweep and what you need to know to make this strategy work for you. So, whether you're just getting started in options trading or you're looking for a new way to add some diversity to your portfolio, read on to learn more about the option sweep. Check out this post to learn everything you need to know about option sweeps and start incorporating them into your game plan. What is an option sweep? An option sweep is a type of options order that sells one or more calls and buys an equal number of puts with the same expiration and strike prices. An option sweep aims to reduce the cost basis of an existing long position in options while maintaining the same level of protection against downside risk. This can be done by selling calls and buying puts simultaneously or selling calls and buying puts in two different transactions. What is an option type sweep? An option type sweep is a market analysis technique used to identify and trade opportunities in the options markets. The technique involves constructing a three-dimensional grid of prices, time, strike price, and underlying stock price, and then looking for trades that take advantage of distortions in the grid. The most common distortion occurs when the underlying stock price moves faster or slower than the implied volatility of the options. How to use option sweep? What is an option alert call sweep? An option sweep is a process of selling all of the options in a given series. When an options trader executes an option sweep, they sell all options at once to realize a gain or limit losses. Depending on how the trade is set up, this can be done by selling all of the calls or puts in a given series. For example, if you hold a long call position and the market drops, you may want to execute an option sweep and sell all your contracts at once to limit your losses. Conversely, if you are short calls and the market rallies, you could execute an option sweep and buy back all of your contracts to lock in profits. Option sweep is a strategy used to create more premium or lower cost options positions. It can help you profit whether the underlying security moves up or down when used correctly. To execute an option sweep, you first purchase a high-priced call option and sell a low-priced call option with the same expiration date. You then purchase a high-priced put option and sell a low-priced put option with the same expiration date. Finally, you net the premiums of all four options and hold the position until expiration. If the underlying security moves up, your profits will come from the two call options you purchased. If the underlying security moves down, your profits will come from the two put options that you purchased. How to set up an account for option sweep trading? To set up an account for option sweep trading, you must provide your name, email address, phone number, and mailing address. You will also be asked to choose a username and password. Once your account is set up, you will log in and begin trading. To place a trade, select the New Trade tab and choose the type of option you would like to purchase. Then enter the details of your trade and click Submit. Good luck! The benefits of using the option sweep strategy. It's a type of option strategy that allows the investor, on the future maturity date, to swap some or all of their position from underlying security with the same strike price for its nearest term out of the money contract from one exchange to another. The main benefit of using an option sweep is avoiding the disadvantages of short options by establishing better hedging ratios and reduced risk levels. This means you have more flexibility in dealing with market volatility because no single trade can put you at significant risk. However, if required, your protection is still intact. Here's how it works. Imagine you hold the right to buy 10 shares of Company X at $X per share, but there is no set expiration date on this contract. You could sell the right to purchase those stocks at your discretion for some price that would be higher than what you pay now for this right. This amount is called the strike. Doing so would make you eligible for any future growth in Company X stock value, known as time value. A benefit of using option sweep is securing potential gains by selling time value or buying even more equity liability when time has passed and expected losses. You get a hedge with less dependence on the trading direction and more correlation towards trading duration. You get more favorable pricing when selecting the value. The risks of using the option sweep strategy. Option sweeps are a way to minimize the risk of a potential loss on an investment. By selling an option with a lower strike price and buying one with a higher strike price, the investor can reduce the cost of the position while still maintaining exposure to the potential upside. However, there are some risks associated with using this strategy. It may be difficult to find an option with a high enough strike price to fully offset the original position's losses. Suppose the underlying security moves in the wrong direction. In that case, the investor could wind up losing more money than they would have if they had held on to the original position. It's important to remember that option premiums can fluctuate significantly over time. Why should you use the sweep technique when trading options? There are a few reasons you might want to use the sweep technique when trading options. It can help you lock in profits on an option trade if the stock moves in the right direction. It can help reduce your losses on an option trade if the stock moves in the wrong direction. It can help you avoid or reduce commissions costs on options trades. Who should use this strategy and who shouldn't? The sweep option strategy is designed for bullish investors on a particular stock but wants to limit their risk if the stock price falls. It's not recommended for investors who are bearish on a stock because they would be better off selling the stock short if they think it will go down in price. Additionally, this strategy should only be used by investors who have a high tolerance for risk and are comfortable with the potential for losses. When would it be a good idea to use this strategy? Whenever you have a stock that is trading below its intrinsic value, the option sweep strategy can be an effective way to increase your return on investment. First, find a stock that you believe is worth more than its current market price. Then, purchase either call or put options that give you the right to purchase, or sell, shares of the stock at a set price by a certain date. Suppose the stock's market price rises above your option strike price by the expiration date. In that case, you can exercise your option and make a profit. If not, let the option expire and lose only the premium you paid for it. The option sweep strategy can be used to take advantage of price discrepancies between different strike prices or expiration dates. What is bull market? A bull market is a financial market in which prices rise or are expected to rise. It is characterized by optimism, investor confidence, and increased trading volume. Bull markets are usually followed by bear markets, periods of falling prices and pessimism. A bull market usually exists when the stock market rises 20% from its lowest point over at least 6 months. What is bear market? Bear markets are typically associated with periods of poor stock performance. Still, the term bear is a descriptor for the boredom and dread that some people feel when markets are not doing well. Bear markets pose a double threat to investors because they also tend to be long periods of low economic growth. This causes stock prices to fall even further, just as unemployment rates rise and consumer confidence falls. Pros and cons for using this strategy in different situations. Bull versus bear. Bull market. Options are great in bull markets because they maximize returns while minimizing risk. This is because when the stock price rises, the premium increases. It's much better to lock in profit when prices are high than betting on them to rise further. Buying options also allow investors with little capital to trade in higher-priced stocks without having huge sums of money right at their fingertips. There are several potential cons of using option sweep in a bull market. It can limit your profits if the stock suddenly spikes up in price. It can also cause you to miss out on potential profits if the stock price falls. Finally, option sweep can be costly if the stock price doesn't move as expected. Bear market. There are several pros of using option sweep in a bear market. It can help you protect your portfolio from large losses. It can help you generate income and profits during a down market. It can help you stay in the game and fight for profits when other investors have given up. It can provide greater flexibility and versatility when trading options. Option sweeps are highly speculative, even in bear markets, and would be particularly dangerous without a short debit spread to control the risk of being wrong. Options are extremely sensitive to movement in the underlying futures contract's price, which means that many trend followers would be tempted to try and use option order types like all or nothing. All or nothing refers to an option strategy where the investor buys, or sells, one out of money call, put, for each in the money, at the money call, put. An example is if I sold an out of the money call at 10 cents and buy back a similar call next month at 2 cents. Let's say that both options expire at their respective strike prices, but unfortunately, our hypothetical company's stock has fallen from $100 to only $50 a share. Theoretically, my losses could be even greater than what they were before because I now need to pay the strike price for both calls. When you're using option sweep, you want to cover all bases by balancing potential profits with equally probable losses.